All right. Hey, welcome to webinar number 3, guys. Thank you so much for taking the time to be with me today and really watch these webinars. I hope they've been impactful for you up to this point and really given you a more well-rounded understanding of how this concept, how this strategy can work for you. So this webinar is the third webinar of a 3-part series, and if you haven't watched the prior 2 webinars, I would encourage you to really go back and watch those first, because I'm just going to pick up right where we left off, and I'm going to continue talking about how this strategy can help you in really no matter what stage of life you're in financially. So in this third webinar, we're going to talk about the real purpose of savings. We're going to talk about how we can use this strategy, whether we want to call it infinite banking, perpetual wealth, or cash flow banking, whatever we want to call it, but how we can use this strategy to improve the overall effect and efficiency of our financial plan. In the last webinar, we talked about using the policy like a loan, like a bank. In this webinar, we're going to talk about truly the real purpose of savings. So think about it this way. What have we been saving for all along, right? And we're going to start off with a little case study here. I've got 3 individuals, and we're going to really understand what it is that these individuals are trying to accomplish. So let's look at this from a standpoint of financial independence. Are any of these individuals, able to be financially independent? And by that I mean, does the cash flow from their assets exceed their expenses? Are they able to retire or make different choices with their life? So let's look at individual number 1, okay? Individual number 1, we've got a doctor here. She's making a good income, right? She's got $250,000 of income. She works probably really hard for that income. She goes to, wakes up every day, goes to the hospital, wherever she works, but she has to trade her time for that income. Now, she has about $450,000 of combined assets, so is she ready to retire? Is she financially independent? Well, not knowing where her assets are, I mean, if we just took that $450,000, she could survive about 2 years or just under 2 years and replace her current income or style of life. But she has 0 cash flow from her assets. Individual number 2 here has $86,000 per year of income. He has about $1 million of raw land, but same situation, right? There is no cash flow. So is this individual ready to retire? Is he financially independent? Well, he could sell his $1 million worth of land, divide it up and sell it. And assuming that, he could get $1 million back, he'd be able to replace his lifestyle and his income for about 10 years. But probably not enough, not in a position to be able to retire. Individual number 4 here, she's a teacher. She makes $40,000 a year, but she has 10 rental properties. And more importantly, she already knows what the cash flow from her assets are. Her 10 rental properties produce $3,800 a month of retirement income. So if we take that $3,800 and we multiply it by 12, she's generating about $45,000 a year of retirement income. So out of these 3 individuals, which one is financially independent? Technically, which one could retire? Well, it's individual number 3. And here's the interesting thing. Do we know anything about her net worth, right? We don't know anything about what her net worth is. But these other 2, we've really focused on, hey, their net worth is X. So the main point I want to point out here is it doesn't really matter what your net worth is. Only when we understand how our net worth can convert to cash flow or income can we really evaluate the effectiveness of the assets that we've accumulated. So this whole webinar is obviously focused on that, cash flow, maximizing income, putting you in a position where you can get ready to retire. So in the first webinar, I gave you this mountain example where, in a financial plan, there's really 2 phases of your financial plan. There is an accumulation phase of your plan, right, where you're going up this proverbial financial mountain and, working and saving money. And then, we plant our flag up here at some points, and we want to turn our accumulated assets into distribution or into an income stream. So the last exercise that we went through, the whole purpose, does it really matter where your assets are? Well, it for sure does. And the reason it does, we want to evaluate how well our assets will produce income. This is what we really want. So a lot of clients come to us right up here. They're in their 50s, and they start looking a little bit more closely at their financial plan, and they're realizing and wanting to be able to retire. And they kind of realize that they might not have as much as they thought they would, or they're not really certain about how to convert their assets into income, not really sure what to do, all of that kind of stuff. So this is really where this concept shines through. And I'm going to show you how we can really take your assets, make a few simple changes, and make a really big impact, okay? So, what are some of the things? Put yourself kind of up here at the top of this mountain, right? And as you're listening to this, maybe you're in your 50s, 60s, 40s, but if you think about it, how would you convert your income, or excuse me, your assets into income? And what would be some of the things that you might be a little bit nervous about? Well, if you're like most people, you've probably accumulated your assets in the markets. And a lot of people tell me they're nervous about what the market is doing and what it will do in retirement. You might be nervous about taxes, right? You might have put your money in accounts that have deferred your taxes. You might be nervous about inflation. You might be nervous about healthcare or any number of things out there. We're actually going to I'm going to actually show you how to solve these problems, but I'm going to introduce to you the biggest problem with retirement planning and how we ultimately can solve that as well. So let's dive right into it, and I'm going to start off with a question. What if I told you that you could generate 20 to 80%, that's not a misprint, but 20 to 80% more retirement income really from the assets that you already have with just a few simple changes? Would that be appealing, right? Would that be exciting? For sure, that's something pretty amazing. And there's been client after client that's come in and have been worried about retirement, and with a few simple changes, we've had clients that have been able to retire early, that have been able to enjoy more retirement income than they thought they would, that have been able to buy a second home or do some of the things that they didn't think they were able to do by making a few simple changes. So that's really what we want to focus on here, is how to organize our assets to maximize the real purpose of savings, which is income. Now, for a little bit of context, obviously, as we do, um, retirement is probably one of the most nerve-wracking times for people. They've worked so hard for 30 to 40 years, and there's so much volatility, there's so much nervousness in our world today, and I acknowledge and feel the same in many aspects. But here are some of the big issues. These are some of the headlines that people feel around retirement. MarketWatch says our next big crisis will be a retirement crisis. And the reason for that, well, 77% of Americans don't know how much of their retirement savings they can safely spend each year without the risk of outliving their assets. U.S. News says looming retirement crisis. 61% of retirees are more concerned about outliving their money than about dying. So you can kind of see where this is, where this is going. Most people, they just don't know how long they're going to live. They don't know how to determine income. And the only strategy that Wall Street or traditional goldfish advisors will give you is this. Well, I guess let's talk about the strategy after we define the problem a little bit more. Here's one of the big challenges with all this, right? A male who makes it to age 65 has an 82% chance that he'll make it to age 80. He has a 70% chance that he'll make it to age 85 and a 50% chance that he's going to make it to age 90. Okay, so pretty crazy. I mean, 50% chance that you're making it to 90 and beyond, right? Females typically live longer than males, so a female who makes it to age 65 has an 85% chance that she'll make it to age 80, a 75% chance that she'll make it to age 85, and a 57% chance that she'll make it to 90. But here's where it becomes almost impossible. This is where it makes it so difficult for so many people. If a couple makes it to retirement, there is an 80% chance that at least one of them is going to make it to age 90, and a 50% chance that at least one of them is going to make it to 95. So the crazy part about retirement planning is we need to make our money last, in many cases, 30 years, probably as much time as you've been accumulating your assets. I mean, think back over your career. How long has it been that you've been working? Right? You now need to make your savings last that very same amount of time. And with all the concerns and questions about Social Security, the burden of providing retirement income is resting more and more squarely on individual shoulders. So what is the traditional approach? How does Wall Street tell us to solve this? I mean, they're the ones that kind of helped most people accumulate whatever they have up to this point. So their approach isn't very appealing, but you've probably heard of it, right? Google this if you haven't. This is all over the internet. Most retirement planners, traditional retirement planners, will tell you about a 4% rule. And all the 4% rule is it's Wall Street's version of telling you how much money you can and should take out of your savings or out of your assets to give you a higher, or I guess a lower probability of not running out of money, okay? So this graph, what it's really measuring is it's measuring the probability of not running out of money, It's measuring the years into retirement, how long we need our money to last, and lastly, it's measuring how much money we take as a percentage of our total assets out of our assets. Okay. Okay, so for easy math and for easy understanding of this, let's say we've got an individual who has saved $1 million, okay? Using traditional strategies, if this individual has a retirement goal that he or she wants to replace or have an $80,000 per year income, that would be taking 8% of the $1 million. So $80,000 a year of income is 8% of $1 million, and here's the challenge, right? This graph, what it shows us, and this is based on an evenly distributed portfolio of 60% bonds, 40% stocks. And what we notice here is 20 years into retirement, something kind of starts to happen, right? The portfolio has been drawn down pretty quickly. And right about here, there's about an 80% chance that this individual is out of money, literally completely 100% out of money. They've taken out too much from their assets too quickly. There's about a 20% chance that they have at least a positive portfolio or at least $1 left. But think about this like jumping out of an airplane. If you're going to go up and go skydiving, you get really one chance to jump out of that airplane. As soon as you jump out, it's not like you can go back to the airplane because things didn't really work out. Retirement's kind of the same way. Once you walk away from your earned income, once you walk away from your job, the further removed you are from that, the harder it is to go back, and really nearly impossible the further you get away from that. I mean, think about someone who retires at 65, 20 years in, they're 85. Can they go back and be a corporate executive? Can they go back and be a surgeon? Probably not, right? So here's the challenge. We are out of, people are out of money, and there's not a whole lot they can do about it at that age of life. So to solve that challenge, this is where the 4% rule comes from. If you want a higher probability of not running out of money, right, then what Wall Street encourages you to do is to take a lower distribution rate, or thus the 4% rule. So if you're taking 4% of $1 million, that would be a $40,000 a year income. If we go back to that 30-year time frame that we're trying to shoot for, at this point you have an 85% chance that you've made it. You haven't run out of money. There's a 15% chance that markets were a little bit more crazy than we thought and you have run out of money. But doesn't that bring up a new problem? I mean, is retirement really the retirement of your dreams on $40,000 a year of income? It's not. I mean, that's not enough to travel. That's not enough to do what you want to do in retirement. So it brings up a whole new set of problems. And to kind of clarify this and make this even a little bit more discouraging, Dr. Wade Pfau, if you don't know him, Google him again. He's one of the leading researchers around retirement income. And what he says is the 4% rule cannot be treated as a safe initial withdrawal rate in today's low interest rate environment. So ever since 2008 especially, the government's been trying to stimulate the economy and get things rolling a little bit better, and one of the main ways they've been doing that has been holding interest rates down to historic lows for a historic period of time. And this is literally, I mean, it's really destroyed retirement from so many people having such low interest rates, because now you're forced into a position where you have to take more risk if you're using market-based investments. So low interest rates, what Dr. Pfau says is if you want to be able to retire and have less than a 1% probability of running out of money using a market-based strategy, if you want your money to last 30 years, the most you can take as a distribution rate is 1.8%. Now, let's just go back and do that math. If you have $1 million, 1.8% is $18,000 a year of income. If you want your money to last 25 years, you can take $23,000 a year of income. And you can see this is just pitiful. I mean, whoever would have thought $1 million would generate that much income for you in retirement? So there has to be a solution, right? Well, there is, and this is kind of what you're here for, right? So we're going to talk about maximizing income, and the real goal of savings is truly maximizing income. Now, here's the challenge, right? As we went up here, we talked a little bit about we don't know how long we're going to live. And if we don't know how long we're going to live, we need to assume that, one of us is going to live 30 years. And so we have to make our money last for a long, long time. So what if we could kind of see the future, right? What if you retire tomorrow? You're up on that mountain here and you're ready to retire. And I can tell you, hey, I know what the market is going to do over the next 30 years. I know on an average rate of return standpoint what the market's going to do. Would that help you in planning for your retirement, if I could predict the future for you? Well, most people would say yes. So if you had all of your money in a market-based investments, right? We know that the market sometimes goes up and the market sometimes goes down. Now, it's the downturns in the market that we're extremely concerned about. So let's take a look at what this does, what impact this has on a retirement plan. Okay, now again, remember, I'm predicting the market for you to kind of prove a point here. So what if I could tell you, you have $1,000,000, okay? So you have $1,000,000, and I could predict that the market's going to do 14.76% on average for you over the next 30 years. So if you know the market's going to average 14.76%, you would probably feel comfortable taking maybe 10% income out of your assets, right? If you've got $1,000,000, let's add one more zero there, you've got $1,000,000, so you're going to take 10% or $100,000 out as income. Let's add one more zero there as well. So $100,000 out of income, but we're earning more than we're taking out. So notice how this goes. $1,000,000 earning 14.76%. We take $100,000 out of income, but we earn more than we take out, so our account goes up in value. Okay, so you'll notice, I mean, every single year you're taking out $100,000, which is 10% of the original asset value, but we're always earning more than we're taking out, so our account is always going up. Now, if retirement were this easy, why would we even be on this webinar, right? So here, I'm kind of setting you up here for what it is was actually happening. So 14.76%, most people would say that's a pipe dream. I actually got these numbers out of the markets, and I assumed, you know, hey, what if you retired in 1970 and you ran your portfolio all the way to 1999? So if you were in the S&P 500 with dividends, over this 30-year period of time, the market truly did average 14.73%. But we had to ride the roller coaster to get it, right? You had to take a 3%, a 14%, 18%. You had to lose a couple years, and a 36%. But if we add all of these rates of return up and divide it by 30, it truly did average 14.73%. So I want to prove a point here why volatility is so challenging for most people in retirement. So I'm going to take this 14% out, and I'm going to replace it with the actual earnings rate. So we're still averaging 14.73%, but here's the challenge, right? We have $1,000,000. We take our income of $100,000 out, but we only earn 3.48%. So we earn less than we take out, and we drop our account balance. Our account goes from over $1 million down to $930,000. In year two, we take our $100,000 out, but in this year we earned more than we took out, so our account goes slightly back up. In year three, we have $100,000. We earn more than we take out. Our account's back over $1 million. But this is where retirement falls apart and the market falls apart for so many retirees, right? In year number four, there's a 14% loss. Now, if this is the only place that we can take our income from, that $100,000 we take, we also lose $130,000. So it's a double negative impact. And it takes our $1 million from $1 million down to $776. And in this example, 2 down years in a row, 5 years into retirement, our account balance is cut in half and we're down to $500,000. Even though the market averages 14.7%, the volatility wrecks that average in retirement. So in this example, we're out of money in 1983. So just, 13 years into retirement, we're out of money. So obviously, what do we do to fix this? Let's go back to this bucket scenario, okay? If all of our money is in the markets, then this volatility, especially the downward volatility, cannot be handled by most people. So what if we kind of plan for this from the beginning? What if we were able to spread our money out and have our money in 2 different locations? Now, a lot of times when people come and work with us, they already have a lot of money accumulated in the market in 401ks because they've been following really traditional advice up to this point. But what if we stop accumulating in the market and we keep the assets that we have there, and we start accumulating in a life insurance policy specifically focused on cash value? So let's go down here really quick and let's talk about this. We'll come back up and do the bucket strategy, and we'll go back to the case study. But remember, in the second webinar, we talked about how these policies work. We set up a policy based on how much you want to put into the policy. The policy is set up so you are in control of it. You'll know exactly what you have and exactly how you can use it. The main focus of the policy is to build cash value. And the reason that we want the policy to be set up focused on cash value is we get some tremendous benefits that will tremendously enhance our ability to maximize retirement income. Number one, we get a guaranteed rate of return. On top of that, we get a dividend. Today, these policies are paying somewhere between 5 and 6%. It does kind of depend on your age and your health and that kind of stuff, but they're paying somewhere between 5 and 6%. And man, you've got this foundation, you've got this floor of guarantees that you know you're always staying positive, right? And you're not subject to the market volatility. Your money's safe, right? Again, not subject to the market, private contract. This will be a big one that we're going to talk quite a bit about, because your money comes back to you tax-free. Your capital is liquid, and in the first webinar, the second webinar, we talked about how to use your policy like a bank. Today we're going to talk about how to use your policy like a stream of income, taking distributions. So let's talk about this, and then lastly we're going to hit the benefits of having a death benefit in retirement. So let's say that we have $500,000 in a life insurance policy. Okay, if we go back up here and our money is spread evenly between these two locations, here's the interesting thing. We can use this first bucket to offset the volatility or the risk of the second bucket, right? So we know the market's going to go up and it's going to go down, but if we have a foundation that we can sit on and rest on, we can use the best that these buckets have to offer. Your policy is always going to give you a foundation of assurance. The market might give you maybe a higher rate of return, but you have to ride the volatility along with that. So let's look at this case study one more time. So let's go back to our calculator. And here's the thing, right? Let's say we're taking down our assets, right? We're taking income out of our assets. But here's the challenge. In the first year, we can never predict what the market is going to do, but we can react to it. And in this example, in year number 2, if we realize that, hey, the market had a down year the prior year, all we would have to do is not take, whoops, change that, restore. Let's see if I can do that. All right, let's copy this up, sorry. All right, copy, paste. Okay, so in year number 2, we would look back and say, hey, the market only earned 3.48% last year. We earned less than we took out, and so we drew our account down. So in year 2, what we would do is we would take income from our other bucket. Now, here's the interesting thing. If this is tax-deferred money, right, after you pay your taxes, you're probably going to be left with maybe $70,000 of spendable income. Well, if you can pull your income from a tax-free bucket, you would only need to pull $70,000 and still maintain your lifestyle. But notice what this one thing did for us. By offsetting the risk of the market just 1 year, now we don't run out of money until 1986. It bought us 3 additional years. Remember, we were going to run out of money in 1983. Now we don't run out of money until 1986. Okay, so it bought us 3 additional years. So in year 3, we look back and realize, hey, in year 2, we had a good year. We take our income from our market-based account. Year 4, we look back and say, hey, we had a good year. We take our income. Year 5, we look back and we say, hey, market lost money, right? And not only was it just a flat year, it was a down year. So again, in year 4, we would not take income from our market-based account. We would give our account a chance to recover, and we would take our income from our policy. Okay. Now here's the cool thing. We've only buffered 2 years in a row, or 2 years now, and now this allows our account to stay all the way, good for 22 years. Okay, so 2 years buffering gave us 22 years, and in this example, since we have 2 down years in a row, we would not take income from our market-based account 3 years. And here's the cool thing. We can take income every single year thereafter from our account, even in the down years, and now never run out of money in our market-based account. Okay, so what is the math behind this? What is the phenomenon behind that makes this possible? Well, if we go back up to the mountain analogy, okay, I'm going to get back up here to the mountain. The most dangerous time for anyone to lose money in their retirement plan is right up here at the very top of their mountain, right? So let's erase all this stuff here. The most dangerous time for anyone to lose money is right up here, right? The 3 to 7 years before retirement and the 3 to 7 years after retirement. Because think about it this way. In 2008, there was a 40% loss, give or take, on market-based assets. But if you lost 40% down here, and let's say you had $100,000, that's a $40,000 loss. That's not fun to stomach. But if you lost $40,000 up here and you had $1 million of assets, it's the same percentage, but now you just lost $400,000 of your account portfolio. So this is one of the biggest challenges for retirement planners. You know, you have to make your money last for a long, long time. And if your money's allocated to the market, how on earth can we possibly predict that, right? So that's one of the examples here. There's actually a few different examples. We're going to go into another one here. But hopefully that kind of helped you see how you could use your policy as a way to buffer the volatility in the market. So let's look at an illustration based on someone who is getting closer to retirement. So if you came to me at age 50 and you had been saving up to that point in your qualified plan in market-based investments, we would look at what you're doing and we would analyze the effectiveness of where your money's going. And remember, we're going to focus on cash flow. So how effectively will your assets produce cash flow is the question. And let's say we stopped saving in our market-based account and we started saving in a policy. So you're 50, you're planning on retiring at 65, we put $25,000 in every single year, and then at age 65, we stop putting money into the policy and really treat it like a retirement account. So here's the cool thing. We have cash value, and remember, if we need to bridge the gap and accumulate more assets, we can use this money like a bank prior to retirement. But now we end up with $500,000 of cash value. But here's another great thing that we're going to talk about. We also end up with $1 million in paid up, 100% purchased, that we own death benefit, okay? Now you've put in this example $375,000 of your own capital to get these two things. But now how can we use these two things to implement, or not implement, but impact your retirement? Now obviously the first thing here is, remember that cash, you're in control of it. It's not in a tax-deferred bucket, so that's what we're going to go into next, is this money is going to come back to you tax-free. And in just a minute, we're going to add in how we can possibly use the death benefit, okay? So let's go to the next point of discussion here, and it's the deferred problem. So many people today have chosen what's kind of been pitched as the traditional way to retire. And really what happened in the late 1970s, early 1980s, companies in general moved away from pension plans and moved towards defined contribution plans or retirement accounts like 401ks and IRAs. And that spread like wildfire. People started using that, and tax advisors and CPAs and financial advisors, they all say defer, 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 right? You're going to put your money into a bucket. You're not going to pay any taxes on it today. In fact, you're going to take a deduction today. And then at some future point, when you get ready to take your income out, then we're going to pay taxes in the future. So this right here is literally a ticking time bomb that is probably ready to destroy your retirement, and let's talk about why that is. Okay, the three buckets of investment. So from a tax standpoint, right, if we're just looking at this from the tax code, where can you put your money? Well, you can put your money in a taxable account, right? This would be things like your savings account or CDs or things like that, and you pay taxes as you go, right? So every year you get an income statement from your accounts that you're taxed on. You have to report it, and you pay taxes on it as you go. You can put your money in a tax-deferred account, right? And that tax-deferred account, this is, we put money in today, we don't pay taxes on it today, and we kick that liability down the road. Or you can put your money in a tax-free account. Now, think about it like this, right? Or I guess before we go there, where do you think most people put their money? Today, obviously, this is the bucket, right? There are over $18 trillion estimated in a tax-deferred bucket, in a tax-deferred bucket. And this is by and large where most people have chosen to put their money. Now, on the tax-free side, it's probably because most people don't know that there are really three options to truly have your money tax-free. So number one, you can choose municipal bonds, right? Munis. You can choose a Roth IRA. And these are government qualified. I mean, a municipal bond is attached to your government, and there's concerns around several state and federal governments, bonds if they can produce. Roth IRA, there's contribution limits. It's still tied to the market in many cases. The third opportunity for tax-free growth is a life insurance policy, right? That's one of the huge reasons that we use these policies, is because everything that comes out of this is going to come back to you tax-free. So let's look at the tax code and let's really dissect this a little bit and try to understand if this is something that's going to be an issue for us in retirement. Now, there's an ebook that we've written associated with this that you can read more detail on, but I'm going to go through this kind of quick. So the biggest threat to your retirement, if we took a bet right now, if we got in a room and said, okay, let's take a bet. Are taxes going up or are they going down? I think most people are going to take the bet that they're going up. Now, none of us want that, but that's really, we're almost left with no choice there, right? So let's just look at one graph that might indicate that taxes are going to go up. So this is the federal debt, tracked over the last 40 years. So going back to 1965, right up until, the year 2000, we can see the debt kind of ticked up a little bit, right? And it increased by $5.6 trillion over 33 years. So in early, in mid 2000s, beginning really right around 2007, 2008, the debt has not gradually gone up, it has skyrocketed up, right? And at the end of 2015, it was over $18 trillion. It's 2016 now, close to the end of that. It's over $19 trillion now. It's gone up by $12.7 trillion in the last 14 years. So it took 33 years for it to go up by 5.6 million, and it only took 14 years for it to double that pace and go up to over 19 trillion. So is there going to be a problem? Let's take it one step further. So let me ask you a question like this. Let's say that I want to be your business partner. And let's really talk about how these qualified plans really, really work. So let's say I come to you and I like what you're doing. I don't really know what you're doing as your business, but I want to be your business partner. And I have 4 rules in order for us to be business partners, okay? Okay, and to be your business partner, here are my 4 rules. Rule number 1 is you have to do all of the work, okay? In our business partnership, it's really up to you. You're going to do all of the work. You're also going to put in all of the money. So in our partnership, you're going to do all the work, you're going to put in all of the money, and you're really going to take all of the risk, okay? So these are the first 3 rules. You do all the work, you put in all the money, you take all the risk. If we lose money, it comes out of your share, not mine. And the 4th rule, I'm gonna keep our partnership really intentionally vague. I'm not gonna really tell you how much of our business that I jointly own. Don't worry about it. I got your best interest in mind. Although you're doing all the work, putting in all the money, and taking all the risk, I still have your best interest in mind, right? Do you wanna be my business partner, right? Are you gonna be my business partner under this set of circumstances? No, you're gonna kick me right out. And the last rule here is I'm not going to tell you how much of our business I own until we get ready to sell our business. So when we get ready to sell our business, at that point I'm going to come in and say, hey, business partner of mine, this is how much money you actually owe me based on a future arrangement. So is this not how qualified plans like 401ks and IRAs, is this not how they work? We put in all of the work, we do all, put in all the money, we take all the risk. And today we know what taxes are, but do we have any idea what taxes are going to be in the future, right? I mean, we have a strong indication that they're going to go up, but let's look at this. Do you think they will go up? Okay. So this is a David Walker right here. David Walker used to be the comptroller, which is basically the CPA of the federal government. David Walker had an inside view of how the governments at a holistic level, how they handled their budget and their finances. And what David Walker says is it's an inevitability that taxes will go up. And he kind of gave it a 4-letter word. So if you had to guess what that 4-letter word would be, why will taxes go up? You might say wars, you might say, kids, you might say all kinds of 4-letter words. But what David Walker says in true mathematician form is he says it's a math problem that the government has. There are 4 things that will guarantee that taxes have to go up. It's number 1, entitlements, number 2, debt, which we just looked at, for people moving into retirement, loss of deductions, and inflation. So let's look at this at kind of a holistic level, and let's look at why taxes are guaranteed to go up and why we'd want to defer this ticking time bomb. So here's the math problem. Whew. All right, for every dollar that comes into the federal government in taxes, back in 2012, 76 cents of every dollar, or 76%, went to 4 government locations: Social Security, Medicare, Medicaid, and interest on the national debt. So in 2012, 76% of every dollar went to those 4 locations. And the math problem that we just talked about above, what David Walker predicted is by 2020, if something doesn't change, and obviously nothing's changing, 92% of every dollar collected by the government, 92% or 92 cents, will go to these same 4 things. And the reason for this, the baby boomers, you guys are retiring faster than anything, right? Some people say there's 10,000 baby boomers retiring every single day, which means the demands on Social Security is going up, the demands on Medicare is going up, the demands on Medicaid is going up, And obviously our government can't stop spending money, so the national debt is going up as well. So this one reason, or these four reasons, I guess, is the mathematical certainty that taxes have to go up. And what David Walker predicted, and you can read a lot about this in the book that'll be attached to these webinars, is that if something isn't done, taxes have to double. Now that's kind of crazy, right? I mean, today if you're in, let's just say a combined bracket of 25%, if taxes go up and your taxes go from 25% to 50%, what does that mean for your retirement? So taxes either have to double or spending has to be cut in half, right? Which one of the two will it be? That's kind of scary. So here's what we're gonna do. In fact, before we go there, let's bring this last calculator up and let's look at this from a income standpoint. Remember, we're evaluating where to put our money based on income. So let's put you back at the top of that retirement mountain, right? Let's say you've got $1 million, and let's say this is all you have again, right? There's no two buckets, you just have $1 million. We looked at the fact that we can't ride out the volatility of the market, right? So if you have $1 million and we're nervous about market volatility, where can you put your money to keep it relatively safe, right? If it's in a tax-deferred status, we can't take it out, right? I mean, we're going to have too big of a tax bill, so we have to slowly draw it out. But here's the thing. If you want your money to be safe today, where can you put it to earn a decent rate of return? And you might choose CDs, you might choose low volatility mutual market or money market accounts. But the best you could expect today would be maybe 1, maybe 2, maybe 3% of earnings. So if you have $1 million earning 2%, and we decide that you're going to live for 30 years, right? And we try to draw your income down over a 30-year time frame, and let's say state taxes are 5%. If this is the case, and we've deferred our taxes, if you have $1 million earning 2%, and we draw this down slowly over 30 years, you could take a $44,000 distribution. Tax rates as they are today, taxes 2016, married filing jointly, you'd owe $8,500 in taxes, leaving you with a net spendable amount of $36,000. Now that's crazy, right? I mean, that's retirement. That is not the golden years of retirement. Now again, what if taxes double, right? What if taxes go from 25%, let's just say they go up to 40%. What does that mean, right? That means that you are the first one to take the hit on that. So you take $44,000 of income, but you pay half of that or $19,000 of that in taxes, and you're left with $25,000 of spendable income. What is your alternative? Can you maybe take more risk? Can you do something else? I don't know. I mean, that's a pretty desperate situation. So let's look at this at the other end of the equation. What if we knew this from the very beginning, and rather than having $1 million in a tax-deferred account, we had $1 million in a life insurance policy cash value? Today, these policies, like I said, are earning about 5%. And here's the crazy thing. We're earning 5%, but it's the same safety, right? I mean, over here, we have to take 2% if we're working with banks and money markets and things like that. But a life insurance policy today is paying 5%. So you're earning twice the rate of return, and you get the same safety, backed up by companies who have done this for hundreds of years. But here's the big thing. As you're pulling your money out over this same 30-year time frame, right, it doesn't matter what taxes are. It doesn't matter if they double, triple, or quadruple. Your money is coming out 100% independent of taxes. And here's the thing. This is how we double your income, right? Over here, you're getting $36,000 of spendable income. Over here, you get $65,000 of spendable income. That's twice as much income that you would get simply by having your asset in the right place, okay? So I hope you're seeing the big picture here. Let's go to the final aspect here. And remember, life insurance policies also have a death benefit. And remember, let's go back up here to this little illustration. All right, so remember here, if we had $500,000 moving into retirement, if we had $500,000 of cash value in this policy, we also have about $1 million of death benefit. And you'll notice these two start to get closer and closer together. At age 70, you've got $721,000 of cash value and $1.1 million of death benefit. But how can we use this death benefit in retirement, right? I mean, is not a death benefit, is it just there for when we pass away? Well, kind of. But let's talk a little bit about it, okay? So let's go down here. Let's say that this couple here, they kind of saw the doom and gloom in the horizon, and they started preparing for their retirement in their 50s, and they started allocating their money a little bit more effectively, having money in a life insurance policy in addition to the other assets that they have. And when they move into retirement, both the husband and the wife have a cash value policy. So maybe that $500,000, of cash value is spread between the two policies. So here's the cool thing. If both individuals have both cash value and a death benefit, they can start to take their income out of the cash value, which comes back tax-free. But here's the one question that we had. How long are we going to live? And since we don't know how long we're going to live, our life expectancy, traditional financial planners tell us we have to make our money last 30 years. Well, if we have a death benefit, let's say the husband passes away before the spouse. And as you notice, there's always more death benefit in a policy than there is cash value. The death benefit left over in his policy will pay out to the surviving spouse, tax-free, again, and that's what will further fund her retirement. Many of the people we meet, they want to leave a legacy or something to their kids. This individual, if she was the one who passed away second, her death benefit would pay out and be the legacy to her family, again, paying out tax-free. But what the death benefit really is it's a permission slip. It gives you the opportunity to spend your assets a little bit more aggressively than you otherwise would have, knowing that when you pass away, you have something that will pay out to your spouse, to your beneficiary, tax-free, and further fund his or her retirement. Now, here's one of the cool things that we can do with many of the insurance companies that we work with. We can actually use 50% of the death benefit while we're still alive to cover things like terminal illness, and if we need long-term care and things like that. You can use the death benefit in several of these policies while you're still alive to cover the cost of those type of things. So, big picture, the whole goal of this concept was to help put you in a better financial situation, whether you're saving your money or you're getting ready for retirement. The goal of this whole webinar was to show you, hey, this is what most people are doing, and it's not working. So in order to have a better situation, it's not about doing what other people are doing, just doing it better. It's literally about doing what other people are not doing things differently, and taking the road less traveled. It's made all the difference for me. It's made all the difference for so many of the clients that I've worked with. So I hope this has really helped you see how this concept can help you maximize the efficiency of your overall savings plan. And if it has, here's the next step, right? The whole goal here was to put you in a position where it's a better way for you to grow your wealth and to maximize spendable retirement income. That's the whole concept here, is it's a better financial strategy. So this mountain analogy here, no matter where you are, right? When we work with you one-on-one, we talk about a foundation. We help you understand the basics of financial planning in general. If you're just starting out, we show you how to build your plan better and more efficiently. If you're nearing retirement, same thing. We have strategies specific to you. If you're in a position where you're already in retirement, we can show you how to get more out of it. If you want to leave a legacy, we show you how to do that. The whole purpose of what we do is we work with people one-on-one and help them understand how this concept can make all the difference in their financial plan. So what's next? Well, we can hope that none of this really is going to happen, and we can hope that our financial planner, our Goldfish advisor, has our best interest in mind, or we can take action. I hope you take action. On this webinar or on this page, you'll have an opportunity to reach out and set an appointment or to request more information, and hopefully you do that. I would hope to meet with you one-on-one and really show you how this concept can help you meet your financial goals more effectively. Thank you for tuning in. Have a great day, and we'll talk to you soon.